What's up, family? This is Justin Smith, and in this video, we're going to address what are the best types of life insurance. We're going to tackle all different types, whether it's term, permanent, universal life, or index universal life. I'm also going to show you how we use the get term, invest the difference philosophy all in one product. And honestly, this is my favorite product. But I also want you to understand the power of accumulating your money tax-free, transferring your money tax-free, and blossoming your money when you pass away, and also accessing that money tax-free within that policy. Most people will buy life insurance for the death benefit, but I'm going to show you why you should use life insurance while you're still alive. Lock in with me. In 1980, a guy named E.F. Hutton said, why don't we use the concept of buy term, invest the difference underneath the tax-free umbrella? Now, a lot of people don't understand this, but they're starting to realize that life insurance is the secret power when it comes to the Internal Revenue Code. This means that any life insurance policy that you get that accumulates cash value, you'll end up getting dividends or interest on that money. Tax-free. Because why would they penalize someone who's trying to protect their family? This is why they allow the money inside of the life insurance policy to grow tax-free. And actually, there's a way you can access that money completely tax-free under section code 7702. And when you die, the premiums that you paid usually blossoms in value from anywhere from 100,000, a half a million, a million, 5 million, 10 million. These vehicles are completely tax-free because they have to take the pressure off the government using welfare programs to fund these families in case of an emergency. And this is why it's a secret weapon. This has also been going on for over 100 years under section 101A in the Internal Revenue Code. So then you have term insurance, where you're paying primarily just because you don't want to have to leave nothing behind or leave debt behind to your family within that term that you're paying for. This is also based on mortality costs. Term is also something that gets more expensive the older you get. So by age 65, 1/3 of the male population is already dead. And this is why they came out with permanent insurance, where instead of paying the pure cost, there's actually a term concept inside of the permanent insurance. So at this time, you're basically overpaying your younger years. So when you get older to your older years, you'll be underpaying, and the rest of those premiums will be going towards a cash value, or what I like to call equity in that life insurance policy. Up until 1980, that cash value has only been credited from 2 to maybe 3.5%. Some companies used to even give dividends in the 7 to 8% range. And when it comes to dividends, it was tax-free because it's basically a refund of an overcharge according to the IRS. If the insurance company was charging you a higher rate and your chances of dying were very slim, that overcharge will build up a little cushion for when you get older and you don't want to pay those higher premiums. And it was tax-free. Then in 1980, E.F. Hutton came out and said, why don't we use life insurance for the accumulation of money and the living benefits rather than the death benefit? This led people to wanting to accumulate their money completely tax-free. Then when they die, it blossoms and also transfers completely tax-free as well. But instead of getting a lot of insurance on a small premium, why not get the smallest death benefit that the IRS will let us get away with and put the most amount of money that we're allowed to put into these policies so we can earn a rate of return yearly of anywhere between 7, 8, 9%. So the cost of insurance is what the IRS requires it to be a tax-free insurance inside the Internal Revenue Code. Keep in mind, if you violate the code, it would no longer be tax-free, and it will also be a taxable investment. It was called Universal Life when E.F. Hutton came up with it because you're able to use it for universal applications. Now, if this is something you're interested in doing to buy cheap insurance, permanent insurance, you can still do that. But what it's famous for, or what it should be used for, is living tax-free benefits. This means you can take the smallest amount of insurance with the most amount of money to make it a cash cow. This is also something that will leave that 401k or the IRA in the dirt. Bye. Now, with universal life being so flexible, there are 3 types. This is something you can put money in for several years, skip the next several years, fund it again the next several years, or not even pay the rest of it at all, and it will continue to grow for you tax-free. This is something whole life cannot do. Whole life was primarily designed for the death benefit, whereas universal life is designed for the living benefits. So what are the 3 types? So back in the 80s, E.F. Hutton came out with this idea and decided to call it the max funded tax advantage life insurance contract. Now at this time, whole life became very competitive. Instead of these rates of 3 and 4%, it got really competitive between whole life and universal life, which is good because they both have their own roles. But when it comes to flexibility, I would consider index universal life. The net rate of returns are still illustrating 2 to 3% higher, and this is on the same amount of money. Most whole lives take at least 7 years to fund or 7-pay. This is because of the tax citations by the name of TEFRA, DEFRA, and TAMRA, which is allowing universal life to be funded quicker due to the flexibility. And this also allows you to get a better net rate of return. Now, when E.F. Hutton came out with this idea, it was considered fixed. This is where you would just be paid on the interest rate in the general portfolio of AAA and AA rated bonds. Now, after the fixed in 1990s, variable came out. Several years later, in 1997, index came out. And index is my favorite one. Here's why. Fixed is known for guaranteeing clients about 3%, which is the lowest you can earn. When variables came out in 1999, they decided to take the guarantees away, which made it a lot more risky, meaning you could lose a lot of money. Then, of course, we have indexed. This is where zero is your hero, and we are guaranteed that the principal that we put in will never lose money. Now, for us to have a floor of zero, meaning never losing our money, we must have a cap. Generally, the cap is anywhere between 13 to 15%. So those are the 3 types of universal life strategies, but I prefer the index strategy, but it has to be structured properly to be able to run those circles around that 401k and the IRA on top of being tax-free. Now, I hope that helped learning the difference between the big 3, which is term, perm, and universal life. You can tell that my favorite is the index universal life, but it has to be funded and structured properly. This is what motivated my team and I to write this free ebook below in the description. So after the video, make sure you click the like, subscribe button, and then click that link where the free ebook is, where you can learn to start to finish the 5 steps of how to become financially free through these tax-free strategies. My name is Justin Smith. This is the Investments YouTube channel. You know what it is. Peace out.